Okay, this is being recorded, and for some of you guys that haven't heard any of my webinars, one thing I mention at the beginning of every webinar is watch this webinar again. And not just necessarily this exact one on the high volatility. You can go out and pick one of the other ones on the ratio call spread that I've done before. Just know that when I do these classes, I try and focus specifically on one aspect of it in a sense. I mean, more so like with volatility here, I'm going to be concentrating on volatility. One of my other ones, I might, because that class was maybe an introductory to options, I'm going to go more in detail to the Greeks and things of that nature. Here, I'm going to kind of assume you know a little bit more about options, at least a vague understanding, and going from there. So, but watch it again because some of the nuances will be lost on you the first time through, because I have a lot of rules that we go through in order to put this strategy into place if it meets all of those rules. So it's not like going online. You can go online and figure out how to do the ratio call spread, and I can tell you right now, it's basically you buy an out of the money call and then you sell 2 calls against it. There you go. You're on your way. You're good to go. That's what they're going to do. This webinar's over. Thank you guys for joining. No, I'm kidding. I have rules specifically in and around this strategy that you need to have in order to set it up. So I'm going to go through all of those and my essentials to success, and then we'll go into the platform and start playing around with that with some real life examples. But I got to get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. I've been trading for over 25 years now with my own money. In that time, I actually started out trading in college, but moved to Chicago after graduating with a finance degree and started trading on the floor. And in this time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. This disclaimer says any opinions, news, research, and analysis or other information contained in this webinar is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Ultimately, what this is saying, you guys, is because I don't know what's in your portfolio and I don't know your risk parameters, I can't possibly give you investment advice, and I completely agree with that. I want to teach you guys how to trade. And, you know, so I actually had a Twitter battle not too long ago. And the guy was like lambasting people that offer these classes, you know, and, you know, why would I want to give away my secrets? And at the end of the day, what this comes down to is if we create a better market, you know, your assumption and my assumption may be completely different. But if we create better markets in these options, then yes, it is kind of selfish of me, because then it helps me out when I'm trading because you guys have made tighter markets, right? That's ultimately what we want to do, is create better markets, create an environment where you guys have a high probability of success. And that's why we're doing this, all right? It also keeps me focused and staying mechanical as well. I don't let things get out of whack. I stick to my rules as well. So bottom line, though, is do your own homework and remember that past performance of any trading system or methodology is not necessarily indicative of future results. We love the work you're doing. Thank you, Trevor. I appreciate that. One last thing, and then I see another question coming up that's a little bit long for me to read, so give me a second here. You can follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat for any kind of wisdom or snark coming from me on the markets. So this is the ratio call spread still. So let me read this question out real quick. At some point later in the webinar, maybe we can explain how someone without naked call permission can buy 1 and sell 2 calls. Yes. Okay. Alan, remind me when I pull this platform up, I'll show you how to do that, and it will make it IRA appropriate as well. All right, so with the ratio call spread online, you'll find that the ratio call spread is a 2-by-1 or a front ratio call spread. Now remember, when you're doing a front ratio call spread, that means you're doing a 2-by-1, not a 1-by-2. So a back ratio spread would be where you are buying 2 calls and selling 1 against it. All right. So that would be a back ratio spread. We are going to only be looking at the front ratio spread today. And with this, we are going to need to have a bullish assumption. All right. We can get away with this market going down though. With a call spread, right? You are directionally held to that move in order to make money. With this one, the way I set it up, you know, if it stayed neutral or even went negative on us, the market started falling out of bed, we are going to be okay. But we want a bullish move because that's how we're going to make the most money. If it does fall out of bed, we're none the worse for it because we've collected a credit on this strategy the way I set it up. And so we don't have to worry about it. All right. So again, we're buying 1 at the money or just out of the money, first strike out of the money with my rules. And then we're going to be selling 2 further out of the money calls against that. And usually what this is going to be is it's going to be about the next strike out. Okay. The beauty in the way I set it up is with the credit and everything else, we are going to be able to set our break even out as far as a 1 standard deviation move. And if you guys have watched any of my other webinars, you know that that 1 standard deviation move is where I love to be because of the rarity of that occurrence. All right. You know, there's only about a 16% probability that that is going to happen. And I'll take those odds all day long, that likelihood of it not happening being 84% is in my favor with this particular strategy. All right. So the way we set it up, we're going to be able to get all the way out there to a 1 standard deviation move. One thing to note is when we're setting this up, you can easily set this strategy up where you create a debit spread. All right. We don't want to do that. It's not worth adding that extra risk in that short call to not get something in return. And by adding that short call, we're trying to limit or remove all of our risk to the downside, or at least in one direction, that being to the downside in this case. All right. And one other thing is try and stay away from stocks under $50 or so, because it makes it pretty difficult to set up a nice wide spread. You're going to basically be doing 50 cent or maybe $1 wide if you're lucky on any stock under $100 or under $50. I'm going to be looking at stocks right around, you know, between 50 and 100 or higher. If it's over $100, you're going to be going to about $5 wide spreads. All right. So what it ends up being. All right. So our essentials to success. This is our checklist in a sense to make sure that all of the parameters line up to make sure that this strategy is appropriate for everything else going on around it. And the first thing that we have to look at is the environment around the underlying. This is the first thing for any strategy to discern whether or not it's going to be appropriate. And with the ratio call spread, long call spread, we're going to go with really low implied volatility. But when you throw that extra call in here, we need high implied volatility, all right, for that underlying. High implied volatility percent, actually, for that underlying. And we don't care about the VIX in and of itself. We need to know where this underlying's volatility is right now in relation to where it's been in the past, because stocks have a tendency to have their volatility coefficient stay in a relatively concealed or floor and ceiling on how high it will go or how low it will go. And I'll show you some of that on the charts as well. But with this one, picking the right environment, we need implied volatility percent for that underlying to be over 50. If it's an ETF, it's over 30. Same rules for any of you guys that have been watching some of my other webinars. You know, when we're doing high implied volatility percent strategies, that needs to be above 50 for a stock and above 30 for an ETF. The reason why it's a little bit lower for an ETF for some of you guys that haven't seen my webinars before is because an ETF, we all know, has several stocks, more than 25 stocks generally in the ETF, and all of their volatility coefficients have a tendency to kind of meld each other out, and it ends up being a little bit lower than what we would see in just an outright stock or outright underlying. So that one, we got that for the IV percent. On the underlying, we have to make sure we have a tight bid ask. And all of these things are going to be, you know, green light, yellow lights. If you have picking the right environment and it's at 49 IV percent for XYZ stock, then just know that that's a yellow light. You're going to be struggling to fit my rules is what it ends up being if you have too low of an implied volatility percent for that underlying. And then with the picking the right underlying, we need to have tight bid ask. So if we're looking at the option montage, and this is the option montage over here for like Macy's, it's under $100 stock. So when we go down here on any stock under $100 and look at the option montage, we look at the closest monthly to expiration. And we used to call this the spot month. You can see that nobody's probably trading February very much. The spot month where the most time and volume is going to be spent is in that option contract that is closest to 35 days to expiration. All right. So in that one, what we need to do to pick the right underlying is we look at Macy's and say, all right, it's under $100 stock. The bid ask in the spot month or the closest to 35 days to expiration needs to be inside of 10 cents wide to the bid ask. And that's on the ones that are just out of the money. The ones that go into the money aren't what we're looking at for this one. We're looking at these ones just out of the money. All right. Needs to be 10 cents wide. If it's over $100 stock, then we basically move the decimal place 3 ticks to the left, and it should be 10 cents wide in this case. So on EA Sports, during open market operations, we should see these markets being around 10 cents wide. All right. And then on, you know, $300 stock, Ulta, we would move it 3 ticks to the left and say it should be 30 cents wide. After the market closes, these markets get really wide, all right, because all of the orders cancel and it's not represented anymore. You need to make sure this rule falls into effect during the open market operations of the contract, all right, so during daily operations. All right, so that's what we're looking for picking the right underlying. It needs to have a tight bid ask, move the decimal place 3 ticks to the left, on a stock over $100. That's how wide those markets should be. Under $100, it should be about 10 cents wider. All right. If you go over that, then just start looking at it as a red light. So if it was like under $100 stock and it's 15 cents wide, just know that it's a yellow light. If it's a, you know, $150 stock and we would say the market should be 15 cents wide and they're 20 cents wide or 25 cents wide, maybe that would be a yellow light. If it starts doubling, you know, if it should be 15 cents wide and they're 30 cents wide or more, then that's where I would start calling that a red light. All right. So picking the right underlying, tight bid ask, picking the right duration. We want some theta decay going on. All right. Because we have a credit. Anytime you collect a credit, you want theta to work in your favor. Theta is the thief in the night that comes and steals your premiums. And if we're looking at the money stocks or the money strikes for a particular stock, you can see that this theta decay starts really ramping up inside of 35 days. That's why I'm talking about closest to 35 days to expiration is where we want to be, because we want our strategy to decay quickly. That gets us to our profitability faster. So if we see this theta decay happening, that's good for us. That's why we're trying to get in here. If we don't want theta decay and we were doing a long call spread, we would want to be way out here so we don't have that theta decay happening. In here, because we're collecting a credit, you know you want, anytime you want or collect a credit, you want this theta decay. All right? It helps you be right even if you're wrong. I mean, if you guys saw my daily market commentaries or the earnings trades I did, right? You saw it yesterday. I did 2 earnings trades. Both of them went in my face, right? Directionally wrong on both of them. But guess what? I still made money on both of them because of the theta decay and setting it up with the right strikes and the right duration and everything else. All right. Picking the right strikes. With this, we want to try and build it out to where we collect a credit, right? We're doing those spreads where we collect a credit, but we also want to make sure that we get our break even close to at least this 1 standard deviation move because of the rarity. You know, if it were to finish outside of here, outside of this 1 standard deviation move, my pen doesn't want to work. Outside this 1 standard deviation move right here, you add up all these percentages and you're going to get about a 16% probability. That means for an underlying, well, this is on the put side. You know, you could look at it either way. This is the call side. But what we can do is add up all of these out here and see that that is a 16% probability of the market rallying up and finishing somewhere outside of this or higher than this area. An 84% probability that it's going to finish down here in all of this area. So that's why we want to try and get our break even up to this, at least this 16% probability. Because, you know, you guys will know that I will take a scratch and say that's a win every time. A scratch is a win in my book. So a scratch or better in this sense. All right. So that's why we want to try and get our break even up here, is because the likelihood it's going to finish down here, and we will be happy nonetheless. All right. And most importantly is, what do we do about our exit? How do we know when our exit is? Well, one of the things that I've mentioned with this is when you go through my essentials to success for a particular underlying and you finally come up to the point where you're saying this ratio call spread is perfect for this underlying, or I think this is the right setup and everything else is working like according to these rules, we have to know our exit strategy before entering the trade. Why? Because that keeps us mechanical, you guys. If you know where you're getting in and you know where you're getting out, that keeps you mechanical. And that is the most important thing in trading, is staying mechanical. It takes the emotion out of it. And that's what I try to do with these rules, is to give you confidence. I go through these rules. I know that I've got the highest probability of success. I know that, you know, Wolfman's been doing this stuff for 25 years and has been working consistently for 25 years. That is another reason to create confidence. And if we write all of this stuff down, we have the data to prove it, to back it up. We know where we went wrong. You're going to be able to look back at it when you set it up. When you set it up, you write everything down. But then when you go back and look at it, you'll be able to see, all right, I followed this, or I didn't follow that one. And that may have been why this all went sideways or didn't work out. And finally, when you've gotten all that, you say, okay, if with this strategy, I'm going to collect, you know, $1 for the strategy, and it's a $5 wide spread. So, you know, I've got a total collection of $6 in a sense. What we're going to do is look to get 50% of that max, 30 to 50% of that max profit potential. If you have a lower risk parameter, go with the 30% in the beginning, but try and ramp that up to getting to about 50% of your max profit potential. So in this case, we'd be trying to get out for about $3. And how do we figure out our max profit? Our max profit is pretty easy. It's that short call or that short strike minus the long strike plus the net credit received. So in that example I just gave, if we did bought the 100 strike, right, and then sold 205 strikes, then our width of our spread is $5. And if we collected $1, we get that extra $1 credit. So that's total of $6 max profit. That's if the underlying on the very final day at expiration is trading at 105. The underlying is trading at 105. The bell rings. That's the only way to achieve your max profit. Okay. And that is, you know, your chances of that happening are slim and none, and Slim just left town. So get out at 50% of your max profit. You're going to be able to get out way before this very end of the day type scenario where gamma starts jacking up. I want to be out of this trade before this all happens. Okay. There's a lot of other things that start going on. You know, big money starts pushing it to where they want, not where you want necessarily. And the gamma. So if those moves start happening, you can see your P&L fluctuate much greater than you will out here. All right. So try and get out at about 50% of max profit to avoid all of those headaches at the end of the day. I see a couple questions coming up, and let me get to those real quick. Can you repeat the strikes again for the long and the two shorts? Well, I will, yes. So what we're doing is we're looking at the one that is at the money or just one tick basically, or one strike out of the money for the long call. And then we're basically going to go at one other strike higher to sell those two calls against it. Now, it may seem like this call spread is very close and that our short call is very close as well, and it has a high probability of being tested. Yes, but remember, we have the whole width of this spread plus the credit received added on to that short strike for our break even. And I'll show you that here in a minute. I know it's probably hard to visualize all that, but we're looking for the strikes to make our spread, and we still collect a credit. Now, I'll show you how to break that down a little bit. It could be a little confusing when I'm just kind of explaining. What are the margin requirements for the extra short call or put? Tom, that it will depend on your level of what your margin requirements and what platform you're using and all of that stuff. It will increase your margin for sure if you are having the naked short. I'm looking at the SQ and a bit further out of the money by Adam. Let's look at that here in a second when I get through this. We need the underlying to move to the short strike, right? Yes, to get the max profit. That's where you need. But in order for us to achieve 50% of that max profit, no, we don't have to have it go straight to that short strike. 2/3 of our way there, we could easily see our max profit potential, or our max profit target, which is 50% of max profit, right? Our target potential happening much sooner. All right. But because we have that short call, our max loss is infinite. I'll show you guys a way to set it up where it makes it IRA appropriate. You can limit some of your margin in some cases. But no, don't allow this strategy to go up to the short strike or the defined long call. That's going to be way out of the money to make this appropriate, because all it is to avoid the rules rather than to save you guys anguish, okay? Just make sure you know that. We're not going to let it go that far. All right. Excuse me. All right, so this is where I want you guys to pull it up. The first guy, David, I think, or John said something, it was Adam. One long against two short calls are not allowed in an IRA account. That is correct, because they don't understand the options. All right, so let's go and look at it. We don't want to set this strategy up around earnings, okay? Right now we're in earnings season. There's a lot of strikes up here that have earnings that are going to meet that rule above IV percent of 50. Another thing is the reason why I don't want you to set this up with earnings is I have specific rules for my earnings, what timing is to set it up around that earnings trade for an earnings event. And the other thing is if we set this up, a month or let's say 2 weeks before the earnings event, we are going to see volatility continue to expand heading into that earnings event, which is going to hurt us. We want volatility to come out. Volatility contraction coming out is going to be a major perk to this strategy. As you can see, we know volatility, which is Vega, affects the premiums over here, all right? So for every 1%, so from 38.68 or 37.68 to 36.68, that 1 percentage point drop will have this Vega coefficient, which is volatility, come out of this premium. So every 1 percentage point drop, we get 35 cents out of the premium, all right? So that's why we don't want this volatility to go up, because if it goes up from 37.68 to 38.68, nothing else changes. The market stays right here, right at 305. Then we will see this premium increase by that 35%. We don't want that. We want the premiums always to go down. We want this theta component to come out daily, and we want this volatility component to come out. All right. So one example I was looking at, because EA Sports just had their earnings, they don't have any earnings coming out. The volatility did kind of come out, but there's been a lot of stuff going on with EA Sports, right? They came out with crummy earnings. Fortnite's crushing them in the gaming space. Well, that came out. Then I tweeted out, I don't think that was the catalyst to turn this around, but I tweeted out, it's in the toilet, but know that this new Apex Legends game that they've come out is really popular with the kids. And literally they started crushing Fortnite's records on a bunch of different aspects on how many people were on at one time. I think it was 40 million people at one time, which is an amazing, astounding amount of people. So they started rallying. Now everybody's starting to complain about the same things that they had with Fortnite, with the lag and everything else. So, there's still complaints out there. But anyway, my assumption is EA Sports is back in the game with this Apex Legend. It could take market share from Fortnite, all of that stuff. So I'm bullish, right? So I want to play this to the upside. It meets my rule on an implied volatility percent of above 50, which to come up with that number, what we do is we take a fraction and we get the sum in the numerator and divide that by the sum in the denominator. In the numerator, which is on top of the fraction, we take the sum of the current implied volatility minus the low. So 45, which is the current, right? That's right where that is, minus the low, which is 18. So we've got a total of 27 in the numerator. Divide that by 63 minus the low of 18, and that is 45, right? So 45 in the denominator. In the numerator, what 45 in the denominator, numerator, we had, what was that? 18 minus the 45, that gave me 27, right? 27. So 27 in the numerator, 45 in the denominator, that gives me about 60-ish. So close to that, just rounding everything up and doing the math in my head. So that makes it equivalent. If you don't have the implied volatility percent, you can find implied volatility just about anywhere on your platform. You may have to do the math. I don't know if they do it on other platforms, but that's how you come up with it. And what this says is every stock usually has an extreme high and an extreme low, where they kind of, you could say this is usually where the lows are. And I have no problem with you stripping out like anomalies, like this real low anomaly, and figuring out the percentile yourself. Just stay consistent with it on doing that. All right. So you can figure that out. So the next thing we do is look at this strike that is one just out of the money. The at the monies would be this one. It's slightly in the money by a couple of pennies. You're right. But that would be close to at the money. I like to go a little bit out of the money for mine. So we would buy one of these, sell two of those, and we got a credit. All right. That's what we want. And then I'll show you what it looks like on the risk, on the analyze tab. So we've got the 1x2. Let me just get it down so it's easy to do all the math on everything. So then we'll go over and check out the analyze the trade. And you can see that if this underlying goes higher, that's going to continue on at that trajectory. We're going to continue to lose money. But when we look at this, our break even being all the way at 120.54, that's because if we buy this 110 call, sell this 115 call. If the market goes up to 115, we've made $5 on this spread. So that $5 is really going to cover that extra short call for another $5 to the upside. So that short call is going to continue to lose money for another $5, all right? But we also got this 54 cents that we got to collect at the beginning, which puts our break even just slightly even higher than that 120 strike. So 120.54. So why not do a broken wing butterfly? Trevor, you could, And that broken wing butterfly is very similar to what we're going to be talking about for the IRA. I have different rules for the broken wing butterfly, but it's still, for my broken wing butterfly, I have different rules. It will still be considered a broken wing butterfly to make this fit into an IRA, all right? But not according to my rules of a broken wing butterfly. We're going to throw this strike in there to define the risk just to make it IRA appropriate, but it's going to be like way out here where we don't want to take that much risk. So we would want to cover it before that. All right. But note, by getting that that collection of credit, that makes us profitable if this market goes all the way down. So when I was saying where we currently are is right here, if it stayed right here, we'd still get to keep that 54 cents. And if it even rallies up a little bit, we're keeping it. If it rallies all the way and pins right here at the 115, that's where we get the most credit at expiration. But it's not likely to happen, right? To get that last trade at 105 even and collect the full boat. So we're going to be looking to get out of this strategy probably somewhere about $2.50 to $2.75 is where I'm looking at. And if it rallied up to here, right in between those two strikes, I think that we're going to be very close to that type of credit. Okay. And since you guys are asking about the IRA, what I do with this is I go out and I buy the first strike I can for a nickel, which would probably be this 160 strike. So if I go in here and then buy this one for that nickel, we did lower our credit by 48 cents and our break even by a nickel, but this will allow this to be implemented in an IRA, believe it or not. Just that one buying, one of a nickel, and that's a broken wing butterfly. But that risk is not something I want you guys to take in. All right. I would say if it started trading up here at 125 near my, or 120 to 125 near my break evens, I would be getting out. And the reason why I said the 125, because we could go in here and do this as well. So if you didn't want to be that close and have that much risk on this one, where you're like a 115, maybe it just doesn't line up very well with, you know, your Fibonacci's, and you're like, well, I'd like to get my break even at least above this Fibonacci or something. Then you could probably go out one more strike and then sell two of those, and you're still going to get a small credit. All right. So that's the beauty. And when you have really high implied volatility, you're able to do this strategy and move it out a little bit further. Now my break even is at 125.26, right? So if you don't want to take that much risk, then you can move it out. You're not going to get as much reward necessarily, but you can move it out there. And note, so let's look at something with really low implied volatility that has around $100 underlying or something close to that. So we could say, let's take a look at Disney and see if it works. So 29 days to expiration. It's going to fit all my rules during open market operations, other than it has really low implied volatility. And low implied volatility percent, even for itself, you can see that it's just way down near the lows. And anytime it gets down this low, it wants to move higher. So another reason why we want to implement this in higher implied volatility. But just to show you, you can't do this strategy doing it this way. You're doing a debit. Why add that risk to the upside if you still have that risk to the downside? Don't do it. Stay away from it. If you're going to increase your risk to one side, you need to have a benefit for that. And the only benefit would be to be removing all risk to the downside. Right? If I'm increasing my risk to, you know, infinity and beyond to the upside, I want to make sure that I have no risk to the downside in this strategy. Okay. So you can see easily why we need the high implied volatility percent, because we're doing a debit. We have risk to the downside. We have risk to the upside. And according to my rules, I don't want to do that. All right. What's the purpose of the second short? To get an additional credit. Yes. And when you do this additional short, let's just go back up to the EA Sports. with the EA Sports, if we're doing this in a high implied volatility environment, yeah, we have to do a debit spread here. So we have risk to the downside and risk to the upside, right? So if we sell one more and we say, all right, well, I'm willing to take a little bit more risk to the upside, but to eliminate that downside. Okay. So yeah, you want to get it for the additional credit, but it also eliminates your risk to the downside. That's why I'm trying to emphasize as much as I can. Don't ever do this strategy if you have to do it for a debit. It's not worth it. It's not worth having that incredible risk to the upside and risk to the downside. Eliminate risk to one side or the other. Right? Does that make sense? Why we don't want to do it in this low implied volatility environment? One, we can assume that when implied volatility, we can go through the charts on just about any of them and see when implied volatility gets this low, what does it want to do? Yeah, it could go a little lower, maybe a couple of percentage points, but the likelihood is it's going to go higher, right? On just about any one of them. You can just look at a chart and say, anytime, would you want to be selling when it's way down here? Selling volatility? No, I want to be buying volatility down here. And when it's way up here at the highs, you can see when it gets jacked up here, it wants to come out. So you want to be buying volatility for just that much move, or buying or selling volatility for a big move like that, right? I know you haven't gotten time to go into the details. So do you have a written material on which could be studied for a newbie? Yeah, I have a whole webinar class where we start out with basic introduction to like the Greeks and stuff like that. I give you easy ways to learn what the Greeks are and to remember them, and then start stair-stepping those up as we go. So you can call the same number I'll have here at the end here in a minute that you can call in and talk to them about that course. Okay. You're calling this this is a front ratio spread. This is a front ratio spread. It's not a back ratio spread. The difference between the front ratio spread, and I hope I didn't say back ratio spread. I was trying to say that this is not in the beginning a back ratio spread. This is a front ratio spread. So if we're looking at Walmart, which isn't going to work with that rule, I can tell you right now, you can see it. So it's not always going to work. You can see I'm still doing this for a debit. Don't do it if I got to do it for a debit, even if it's got high implied volatility. But what I'm saying, for a front ratio spread, we buy this one, sell two of those. That is a front ratio spread. A back ratio spread would be buying two of these and selling one of those, and you're always going to do that for a debit. All right. Shows back ratio spread in the order. When I do that, if I buy two of those, it says back ratio. Wait. What do I want? Sell one more of those. Oh, it does say back ratio spread. They're wrong. That's not right. This is a front ratio spread. What does it say when I buy two of these? It's a vertical. Wait, what? Custom. Well, just know this is a front ratio spread. It's not a back ratio spread. John, this is going to be sent out after the webinar. The recording was sent out as an email. One thing to note, I have to compress this, upload it, send it to the home office, and then they will send it out. So it may take a little bit. How do you hedge the portfolio? Is this the portfolio of just an overall portfolio? Because I do have different webinars on how to hedge an overall portfolio that you'll be able to find in some of these webinars also. Right? Yes. Again, reach out, give us a call, and we can get you set up with a custom webinar that you'll be able to take advantage of, Jenky. All right. Anybody else have any other questions real quick? Or do you guys have something you want me to check out? All right, you guys, this is the offer. It's a great offer, you guys. Usually we sell each one of these for about $495 or $97 on a discount. We're combining these right now. We've set up the platform completely different. It's all new look, so you guys will be able to go through these easier and sort through them. One thing to note with this, the floor option hacks, all right? The value here, $495, I think it's worth that value because it will increase your productivity, you guys. If you learn these simple steps to learning these hacks that we used to use on the floor to be able to do this stuff in your head, it will streamline your process of finding different opportunities in the market, which is increasing your productivity. On the other side, on the volatility crush, it's going to be able to let you sleep at night because you're going to understand volatility to a point of where most people out there, and even some of the guys on CNBC, to be quite honest, some of my friends out there don't understand the value of volatility, okay? It's just lost on them. So make sure you take this. You guys will be more confident. You'll be able to watch CNBC and be like, you're out of your friggin' mind, guys. If you watch Wolfman's webinars, you know that is a red light, right? So take advantage of this because combined offers, we're doing this right now for you basically, you're going to get both of these for $495. We're combining these two right here for $495 all in one, or $497, sorry, $497, both of them. So you get both offers for $497. It's 2 for 1 right now. 2 for 1. All right, so take advantage of it. You're getting like 40 hours of content here with all of this stuff, with the volatility crush. Sorry, that got cut off on some of these things. I thought it would actually show up on the side there when I extended it off, but it's obviously not. So, like I said, streamline your process, sleep at night. What better could you do, right? And hey, Joseph, I see your example. I will throw it up there in a second. In a second after we get done with this. Like I said, you take advantage of that. The link is in the chat window. So we've been going back and forth in the questions box over there. I just sent it out in the chat window. You can click on that real easy. If you're watching this on tape delay, you're going to have to pause this and type this into your URL. Ultimately, I just want to say thank you guys all for participating in this. In later webinars, I'm going to be drilling down on different option components, when and where I find those options trades and whether or not they're appropriate. Also, you guys that were asking some questions about different webinars, reach out to us, 310-598-6677, or email me at trading@protraderstrategies.com. We'll get you set up with what you want. We have all kinds of different webinars. You know, if you say you're a newer trader, you want to learn options, we've got the introductory to options course. That's a great one. And then I would say follow through with this one in this course afterwards and go through it as well. So because each webinar, even though I'm saying I'm doing a long call spread, I drill down on a certain component for that course, okay? This one, I'm drilling really down on volatility and how it's going to affect our premiums and stuff and how we want to set this up. So check it out. Go to protraderstrategies.com, sign up for this, pause this URL and sign up for that. I'll give you guys this to sign off with so that you guys can see all of the different videos you get, 2 for 1. It's going to streamline your process and let you sleep at night. What better could you ask for? All right. All right. So ABT, thank you. I appreciate it, Andrew. I know you got to go probably, but I'll throw out Joseph's ABT example real quick. Let's just take a look at it. ABT. For our last example here, we want to first look at implied volatility percent is 27. It's way too low right off the bat. We know it's not going to fit our rules, okay? We're going to expect volatility to start expanding here when it gets this low, all right? So I would want to stay away from it. And we can take a look to see if it even works. You can see buying 1, selling 2 right away. Because the volatility is so low, it's not going to work. All right. All right. That's it. Appreciate it, guys. Everybody have a great week trading, I hope. And if you can't take that, take it easy. Take care, JQ. You always get me. Bye, guys.